Hello, welcome to this episode of the Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to be joined by Ross Metz. Ross is the owner of SIMCAP Holdings, which is a multifamily residential real estate investing firm. Ross started his career as a certified public accountant working for big corporations before transitioning full-time to investing in real estate. Ross has experience with investing in short-term rentals, single-family homes, and also residential real estate. Hey, Ross, how's it going?
Hey John, good. How are you?
I'm doing well. I'm doing well. So I gave a brief introduction for those that are listening or watching in this morning. But if you wouldn't mind sharing just one, a little bit of background about yourself, and then two, what piqued your interest to start investing in real estate?
Yeah, sure. First of all, thanks for having me on. Yeah, I guess we'll start right after college. So I went into public accounting after college, got my CPA. Then I spent, I guess, about 8 more years in the corporate world, working at some large multinational corporations in finance, accounting, financial reporting. Through that time, I was always buying, real estate as a means of diversifying, and just kind of always had an entrepreneurial mindset. Always knew I didn't want to stay in the corporate world my entire career. And just with, my background and the exposure I had to real estate investing, it just kind of made sense. I really enjoyed it. So it was two years ago, I moved into real estate investing full time. That's when we started company SIMCAP Holdings. Um, since then, we've just been focusing on acquiring multifamily real estate. We have acquired 212 units. We started with the bootstrapping model, buying everything on our own with our own capital. And as you can imagine, we ran out of capital. That's when we started doing some equity deals, some syndications, and then finally we just moved into launching our first fund. It's me and another business partner. We have vertical integration with in-house property management, and then we actually just hired our first, I guess we'll call him full-time employee. He started yesterday, actually. He'll be kind of the director of asset performance. The second
Great.
part of your question, what kind of piqued my interest? As I mentioned, it just started as a means of diversifying while I was working a full-time corporate job. Then as I got further into it, began learning a little bit more, and there were just a number of physical and financial kind of aspects that got me hooked. The main thing is the tangibility, the ability to have a direct impact, a physical impact on on the value of the investment. Being a little bit different than a stock investment where you just deploy money and you don't really have any control after that. I used to be a renter, so I kind of know what renters like. Housing is a necessity, so it's not like people are spending extra cash to live. So it's always going to be needed. It's easier to control, being a physical asset. It's easy to understand. And then there's just a lot of advantages, from appreciation to debt pay down to
Mhm.
cash flow. There's certain tax advantages, the ability to leverage and grow your money. Um, and then I guess finally, just simply from an investment standpoint, it's quote unquote a safer asset. So
Mhm.
a lot of different reasons there. It just kind of snowballed and here I am.
Yeah, yeah. Well, that's great, and congratulations on your first hire. In with where you're at up to 212 doors. So one question I have, and I've got clients that are curious in this, and I've kind of like even thought about this in my head sometimes as well. Obviously, now your firm is focused on multifamily real estate, but just from knowing you personally, I know you've also done some short-term rentals, Airbnbs, things like that. So what are what are some similarities and what are some differences, and which one do you kind of prefer now, as opposed to that multifamily kind of that buy and hold, or compared to
Mhm.
the more short-term rentals?
Yeah. Obviously have a bit of a preference towards multifamily. I did own two short-term rentals. Biggest difference from a management standpoint is the short-term rentals are a lot more of an active investment. Kind of have to stay on top of things. It's daily turnover as opposed to annual or many years of turnover before a turnover happens in commercial multifamily real estate. The main thing really is why I'm so attracted to the multifamily long-term play is the ability to get financing. A
Hmm.
lot more strict when you're buying a smaller asset, just because vacancy plays such a huge factor in banks' willingness to lend, um, ability to leverage money, ability to refinance and pull your money out. It's easier to predict, trends in the market. With the short-term play, you never know what the city's going to do. I mean,
Hmm.
some cities were letting short-term rentals happen, and then all of a sudden they pulled the rug. So,
Yeah. Yeah.
number of different reasons why I like multifamily. I just think it's more of a sustainable business. I think there's a larger market out there, and it's just easier to kind of maneuver around and make more money and accumulate, to be honest.
Yeah. Yeah. No, that's good to know. I obviously know people that do a little bit of both. So
Mm.
it was good perspective on that. And now that you're fully focused on the multifamily real estate phase, what do you see as far as kind of the current outlook for multifamily real estate?
Yeah, I think, I was on a call with you the other day, actually, and I mentioned that 2024 is set to be the year where the largest number of units, new build units come online ever. But when you break it down, it's mostly impacting, we'll call them those attractive markets like the Sun Belt. Um, they're just building like crazy out there. Um, but there's still an incredible amount of undersupply.
Hmm.
There's an expectation that there's going to be a decrease in homeowners, resulting in an increase of renters. I think I saw a statistic, don't quote me on this, but with the expectation of an increase of 1% of renters, that yields something like 1.5 million more renters jumping into the market. So,
Yep.
there's an expectation that although there's the huge amount of supply coming online in 2024, starts are going to the real estate starts are going to they're going to start dropping. As interest rates have remained high.
Hmm.
This supply that's happening now is kind of a byproduct of when rates were low a few years ago.
Hmm.
Um, but again, when you get even more micro and you look at Midwest specific, there's actually it's a much better balance of, you know, I guess it's a positive imbalance for people who own the real estate, but there's just a lot more renters than there is supply. Um, when you dig into rent growth, the rent growth in the Midwest has outpaced every other market. Cap rates in the Midwest are higher, so you're still able to capitalize on good pricing. Numbers make sense. And the demand for rentals will remain strong with continued supply and demand issues. Like I said, although
Hmm.
a ton coming online this year, that's expected to drop drastically over the next 2 years. So we'll remain in a lack of a supply imbalance.
Hmm. Yeah. Yeah. It seems to be an interesting dynamic. So when looking at it, if rates do remain high, I guess that appeals, could mean that we have more renters potentially.
Yeah,
It could mean that it's harder to buy if you're trying to finance a mortgage on a property. It seems like your monthly payment would be much higher, and some people might be better off renting.
yeah.
Um, if are those things that you're starting to see as well?
Yeah. Um, I just saw a report yesterday that kind of shocked me in terms of the price difference. It was like the average price of owning a home was like 3,400. Again, don't quote me. And then the
Mhm.
price of renting was something in like the low 2,000. So
Yeah.
the delta was like over $1,000, and it didn't even factor in the cost of home ownership. Repairs,
Right.
maintenance. When you're renting, you're simply paying your utility bill and your rent. You don't really have to worry about any other additional housing expenses.
Mhm.
So
Yeah. Yeah, that makes sense. One of the things you touched on before was could be a little bit easier, from a financing standpoint with multifamily. So, how are you typically financing your deals?
yeah, so kind of holistically, my general belief in business is to kind of stay in your lane, operate in your lane, and let professionals, be professionals in the areas that they serve. So we utilize financing brokers we lean on them heavily for the entire financing process to assist with getting the best financing terms. Um, you know, Going through it so many times, you just kind of know what to expect.
Mhm.
But the main thing is to really understand what is important to the lender. They look at things like global cash flow, having a strong balance sheet, so staying on top of that, different debt service coverage ratio requirements, even knowing how they underwrite specific assets is very helpful because then you can kind of hone in on a number that makes sense to them and that they're going to lend on. So it really comes down to finding good deals as well. Um, Being able to paint a good picture, a lot of stuff that we acquire is kind of on a pro forma expectation, whether it's through value add or just some operational changes to improve performance and efficiency. So
Mhm.
being able to paint a good picture and back it up really helps getting financing. And then it just becomes a rinse and repeat exercise. They request a lot of the same documents and generally have the same requirements asset by asset. But at the end of the day, if you're finding a really good deal and you can prove that you have the background and experience to operate, it's not too difficult to get a loan. And they're just lending. They look at multifamily as a small business, and if it's
Mhm.
producing cash flow, banks love to lend on it.
Yeah. Yeah. Well, great. So, if you wouldn't mind walking us through your due diligence process. So there's, maybe there's a property that comes up on your radar, and you start to get in there and really start to break down the opportunity, break down the real estate. What are some things that go into your due diligence process?
Yeah, so it all starts, I mean, it's networking, connecting with brokers, keeping your ear to the ground and really, just trying to find good assets to come online, if you will. Then it just starts with the underwriting process. As I mentioned before, we have an underwriting model that we mirror kind of like what the banks are looking for in one aspect, but then we also, underwrite to like what we think actual performance is going to be because they're not the same. Banks are a bit more conservative with their process. So
Yep.
going through underwriting, making sure it checks all the financial return boxes. Then you get out there, you see the property. If you like what you see, that's typically a very short, brief property tour, but kind of gives you a feel for the asset. Then you you submit an LOI, just like any other business. Um, there's a potential that there's a best and final, depending on the competitiveness if they're getting a bunch of offers. And then ultimately you have acceptance of the LOI that kind of puts you into the bulk of the due diligence period.
Yep.
That's when you get to review all the documentation, whether it's financial, leases, CapEx spend, etc. During that time, you're kind of coming up with a plan for how you're going to handle things after close. What are you going to do to increase performance and operational efficiencies? So you're kind of getting a game plan for that.
Mhm.
Um, then you have a physical inspection of all units, taking, you can imagine if it's 100, 200, 300
Yep.
unit property, it can take multiple days to do the physical inspection. You also get a professional inspection of the entire property and all the units. And then from there, you're kind of adjusting your underwriting if you find anything. Um, we kind of pride ourselves on not retrading, asking for,
Hmm.
money back or repairs. We kind of bake that into our offer and, hope that we have enough experience that we can kind of plan for those things. But if you do find something, then you negotiate price and do any retrades if necessary. Um, and then you lock in the financing and then you close. The due diligence period can last. We just typically prepare for about 90 days, but a lot
Yeah.
of times it's shorter.
Okay. Great. Yeah, it's a very similar process for purchasing a business
Mm.
as well. I mean, a lot of those stages that you were mentioning reminded me of that process, either from personal experience with doing that or helping clients through that. So, yeah, a lot of the same steps are involved. So one of the things you mentioned on before is kind of the evolution of SIMCAP Holdings, and it sounds like it started from you personally owning some real estate, and then having to raise capital. One of the things that you mentioned was a syndication, and then you also mentioned now the stage of your firm and being an actual fund. So what are what's some of the differences there? What are some of the benefits and when you're mentioning or when you're talking about a syndication versus a fund?
Yeah, so similarities in that you are raising capital, you're pulling together capital to acquire asset slash assets. So that is I mean, that is the similarity, but the
Yeah.
difference being, with a fund, you aren't investing in a single asset. Syndication, you know, you put a property under contract, it's one asset, and you raise specific to acquire that asset. Whereas a fund, it's a bit more diversified. You're investing in a pool of assets that kind of meet a predefined set of criteria. So think of it as like six syndications in one, and kind of what you're selling or you're pitching out from an investment standpoint is they're all going to line up across the board and fit into this box of criteria. So with you investing in it, all you're doing is simply diversifying across like five syndications. The capital raising timeline is much longer with a fund. It can
Mhm.
happen over the course of years. Whereas a syndication, the fundraising timeline typically happens within that 90-day due diligence process that I just spoke of.
Right.
And then with a fund, there's just more legal work and some SEC requirements.
Yeah.
Um,
Yeah.
and then just from an investor standpoint, biggest difference is diversification across multiple assets versus investing in one asset.
Hmm. Yeah. Yeah. That's great. And are there, from a reporting standpoint, I would think with a syndication, one property, you probably not. I would assume performance reporting would look a little bit differently than that as opposed to a fund where you might see, hey, here's a few different properties that we own. Here's your rate of return that you're getting on these, things like that.
Yeah, it essentially boils down to, obviously syndication being one, there's only one thing to report on. Fund, I mean, think of it as, like I said, a multiple syndications. We would report out on an asset, asset by asset basis, but then obviously there's the roll up to
Right.
the overall fund performance. And I guess that kind of speaks to what I see as one advantage of the fund. If one isn't going so well and four are, it's just like investing in the stock market. You have a portfolio. The
Yep.
high performers are gonna, offset that negative impact of one that might not be going so well.
Yeah. Yeah. Absolutely. Very comparable to a mutual fund versus owning
Mhm.
individual stocks. So, yeah, that makes sense. And what are some of the tax advantages of investing in real estate?
Yeah, the most I guess probably well known is what's called a 1031 exchange.
Yep.
That's simply just a deferral of taxes. So you can roll over capital capital gains without being taxed in perpetuity. I mean, you can do it as long as you want. And you just defer that final payment until the final sale of that last asset. I mean, You can even roll it over to your kids and never have to pay it in your lifetime if you want to. Um, I guess the reason for that being it just keeps more money in your pocket, kind of time value of money, um, ability to leverage more capital kind of immediately, as
Mhm.
opposed to getting a big chunk of it taken out in taxes. Then you also have depreciation, which is huge in real estate. I mean, you can re, you can have cash flow, money in your pocket, real money in your pocket, but report a paper loss, and
Yeah.
then use that to offset whether you do real estate full time or not full time. I mean, you can use it to offset income from other things. One thing in regards to depreciation that a lot of people don't know about is what's called a cost segregation study.
Okay.
um, lot to it, but essentially what this is kind of piling up depreciation expense um, in the first year of operation. So you can have a massive loss, whether it's on your K1 or your tax return,
Mhm.
front loading depreciation. Now, you do have to pay that back, when you sell, but again, it's time value of money. And then if you're not selling the property, you're reaping a lot of that benefit. Yes, so I mean, I suggest reading about it. There's so much more to it than that, but that's been
Yeah.
hugely beneficial for myself and my wife. We've reaped some really serious benefits from that. And then finally is just owning an asset. You own it in LLC. It's essentially a mini business. You can get a lot of business expenses and write-offs, um, running different things through your property.
Mhm. Yeah, yeah, that's something that you shared with me information about the cost segregation analysis and basically finding different depreciation schedules for different components that are in that real estate, whether that be appliances, things that other things that are involved throughout that. But you're right, it's a bit of a nuanced strategy and something that would definitely require bringing in a professional to help you out with that. But yeah, it's a great benefit that I've seen, and I've seen for clients as well. To offset income that you have, and like you said, it's a paper loss, but it can lead to real money, whether that be from a tax return, tax refund. So yeah, that's great. And does a lot of that get passed through to, if you're in a syndication or if you're in the fund, some of that get passed through to your investors then?
Yeah, we pass 100% of the depreciation benefits on to investors. I guess one thing to note on that, there are different rules depending on if you're a full-time real estate professional, you get a little bit more of an advantage. But
Yep.
if you're a passive K1 investor, you can still use up to 25K of offset. So, if you have that much passive income, 25K definitely helps. And it's just that's one thing that we don't even factor into our return structure. Like we're not underwriting that in. So
Yeah.
if we target a certain performance, that is just a kicker on top. So it's a really nice benefit. And one thing I didn't mention is, they had phase out periods. There was 100% bonus depreciation year, then it phased to 80, 60, 40, 20. Well, there was a bill that just passed. I think it passed through the House, just trying to make its way through the Senate, in that they're going to extend the 100% bonus depreciation for any property that's acquired I believe up through like January 1st, 2025. Again, not exactly sure of that date, but
Yeah.
it's around there. So this the 100% is hugely beneficial, and it looks like they might extend it. So it's definitely something that can and should be taken advantage of, and it's an often overlooked piece of real estate investing.
Yeah. Yeah. Well, great. So, Ross, I appreciate, all the information that you shared with me today. For those that are looking out, they want to get in contact with you, talk about real estate investing with you. What's the best place where people can find you?
Yeah, you can find me on LinkedIn. Probably better off just emailing me directly. It's ross.metz@simcapholdings.com. You can also check out our website, www.simcapholdings.com. not great on the social media yet, but that's one initiative we're looking to take advantage of over the next year or so is improving our social media footprint.
Well, great. I'm sure we'll start to see more and more content then from you guys. And we'll have links to all that. And once again, Ross, thank you for joining me today.
Yep. Thanks, John. Appreciate it.